Nick, good to see you. Today, we get to talk through recent market volatility. Concerns about a cooling U.S. economy led to a market rout recently, with the Dow down as many as 1,100 points at one point. Stocks and treasury yields paired some declines after service sector data came back better than expected. Market volatility and corrections are, of course, part of investing in the market. Can you explain a little bit about the volatility that's happening right now? And then just taking a look at the S&P 1 week performance here, Nick, we can see still a lot of red on the board.
Yeah, there's still a lot of red. And this is what the government's been trying to do. The government's been, that's why the purpose of hiking up interest rates is so that it's harder to get mortgages. So people put less money in the system. It's harder to get loans for businesses. So there's less money going into the system. Credit cards charge more. That's the purpose of these higher rates that they were doing, is to try and slow the economy down. And that's what they're doing. They hike these rates up, they slow things down. Markets don't go up in a straight line, though. And so that's something that we always have to be aware of. We can get kind of lured into thinking, yeah, hey, the market was up last week, the week before that, the week before that. It's always going to go up. But in reality, that's never, ever, ever, ever been the case in history. And so we have to be aware of that. So with all this volatility, it was kind of due, because the markets had this run up. We've been telling people for a while that now is a good time to, you want to buy low and sell high, and there's been some time to do that over the recent history, recently. But again, this is what the government, the Fed, is trying to do, is to slow the economy down. This is a byproduct of it. It doesn't make me happy, doesn't make anybody happy. But it's something we have to be aware of because it happens regularly.
Mm-hmm. So as you mentioned, the market has been very strong this year. Is this correction in part due to what we talked about months ago, Nick, which is concentration risk? The fact that the S&P 500, 80% of the gains we've seen this year are due to 10 stocks, not 500, 10.
Exactly. And you're right. The tech is driving most of this market.
Yeah.
When we talk about concentration risk, a lot of times it's like, oh, that's one of those big words, concentration. What do you mean by that? I look at it, the Olympics just ended. I'm looking at this as, think about men's swimming years ago. We had a lot of concentration risk in the men's swimming in the Olympics. We had Michael Phelps. He won everything. He touched the water, he won. Well, now if you look at the Paris Olympics, he's retired. He's in the stands now. And how did we do in the Olympics? Not so good. So we kind of had a lot of concentration risk in the swimming market by having everything behind Michael Phelps. So then take that same example and look at tech. Tech has been leading this market. Now tech slows down. And so what happens to the market? The market goes down. I was actually just looking. If we look at NVIDIA from June to August, down 27%. Apple, July to August, down almost 12%. Meta, Facebook, at one point in July was down 16%. Tesla from July to August down 27%. So there's a lot of this happening. A lot of these leaders that have led the market slowed down. It affected everything. And so it's been interesting. It's not a full blown, like every company is buying into this market run up. It's just a few of these things that's done it, and all in one category.
Right. Outsized gains. So I'm glad we talked that through, because of course we see the headlines and we are reacting to generally how the S&P 500 is performing, which is not a diversified portfolio. How have diversified portfolios been performing during this recent volatility?
Good if you're truly diversified. The misnomer is that a lot of people will say, I'm diversified, but they're all in one world of investing. If we were to think about three worlds of investing: the stock market world, the banking world, and the insurance world. These are all places where we can invest money. All are going to react differently to different market climates. If we have everything in the stock market world, no matter if we own one stock or 50 stocks, when everything gets heated, it's affecting everything in that world. And so that's something that you have to be careful of, is, are you truly diversified in just one world? Or are you really diversified by things in all these other worlds? And that's the thing, is, for people who are diversified in all the different worlds, things are so much better for them because when the market went down, yeah, it affected things in this world, but it didn't affect things in these other worlds. So with stocks being down, bonds were up. Alternatives like structured notes held stable. Principal protected annuities did good. Money market accounts are still paying good. But if you had everything just in tech stocks, that's going to be the most affected. It's the most fun when the market's going up, but it didn't go up every time.
Right. So just to show you how irrational humans behave, Nick, on last Friday, a week ago, I plugged into Google, should I? And the first option on that dropdown was sell my stocks now. So clearly people were feeling anxious. What should we be keeping in mind during these moments of volatility?
Math over emotion. Have a plan versus getting emotional about it. Obviously, if you don't have a plan, you need to get one, because this isn't going to be the only week of volatility. This is the first of many. And if we look back at the stock market of 2007 and 2008, there were warning signs in 2007 where the market dropped and then it spiked back up and it lost momentum, and then the rug got pulled out from underneath us. So now is a warning sign to have a plan. If you don't have one, there's 3 rules that we tell people about. Obviously, one we already talked about, the markets don't go up in a straight line. But there's another one called the rule of 1, which means every round about 1 year, with like 18 months to 24 months, the market has a correction of up to about 20% drop. It happens almost every year. Then there's a rule of 5. Every 5 years, the market has a crash. A crash is something over a 20% drop. So you have to make sure that you have a plan that can withstand this. We're heading into a point in our culture where there could be a lot of storms, an election year, new talk about potential recessions, uncertainty, all that type of thing. So you just don't want to plan for good times and ignore the fact that there's hurricanes, there's financial hurricanes that can come out and affect things. So you want to make sure that you're getting out ahead of this. This is one of the reasons we talk so much about not only stress testing your money so that you know the kind of risk that you can have if certain things happen, and knowing if you can weather those storms, but also having a principal protection plan. That you have some of your money principal protected. So if the market does go down, you have a chunk of money that's in a world that doesn't get affected by that.
So asking Google the day of is not a financial plan, Nick?
It scares me that was the thing that popped up. And as crazy as that seems, people have probably taken advice based on what they saw on Google.
Absolutely.
And locked in those losses instead of, the thing that you should be doing is buying low and selling high. So what happened is the market was kind of going like this. Well, there's points along the way we should be raking in some of those returns. But the problem is we wait for this and then we sell, and it's kind of at the wrong time. So, and a lot of that happens because we planned reactively instead of proactively. And I would really suggest now is a great time to be proactive, because you know what? The market might bounce and kind of melt back up again, but that's not going to last forever. We're going to have times when it goes down, and you better have a plan in place so that you're not going on Google trying to get advice from AI and what everybody else is thinking about selling. Should I sell my stocks now? Who knows what advice you're going to get?
Right. All right, Nick. So if somebody would like to come to you to have a financial plan as opposed to just their buddy ChatGPT, what's the best way to reach you?
Oh, ChatGPT, that's our friend, right? That's going to be the best place to get advice. I do like it for some things, but as far as for customized, that's like going to, I still don't know about that, going to a doctor and having a robot operate on my eyeball. I still want the doctor to do it, because what happens if you have a Microsoft blue screen? I mean, look what just happened with CrowdStrike. Right? Yeah. I mean, I'm thinking, I have visions in my head of being up in the air at 35,000 feet, and all of a sudden the computer on the airplane goes blue screen. I'm like, then what? I guess, hopefully, I don't know. I have no idea what to do in that case. But anyway, for us, we like to protect people so that they don't have a blue screen. And what that means is we got to put a plan in place. So the easiest way to do that is you can go to our website, group10financial.com. There's lots of high content on there to get a lot of more information, and also reach out here at the office, 800 group 10, 844 group 10, 844 group 10, and we can set up just a quick call just to check in and see how things are going and what needs to be done, so that you are ready for whatever Washington or Wall Street throws at you.
Great. Nick, thank you.
Good being with you.